Welcome guys, good to have you back. In the previous episode, the focus was on session behavior, how price moves through different parts of the trading day, and how timing influences what gets delivered. So guys, if episode 3 hasn't been watched yet, it's important to pause here and go through it first, because what's covered there carries directly into this lesson. So in this episode, the focus shifts to directional bias. This is about how directional bias forms as the day unfolds, as price interacts with key reference points and reveals intent over time. And guys, if you need to pause, replay, or take notes during this episode, go ahead and do that as we move through the concepts. The goal here is to walk through the process, how bias takes shape, what information supports it, and how price behavior can either reinforce it or weaken it. So with that said guys, let's begin this episode. Okay, so price moves within a clear daily structure, and every trading day has an open, a high, a low, and a close. Now, look at these two candles. On a bullish day, price typically opens, trades lower, then expands higher, and closes near the high. An open, low, high, close sequence. And on a bearish day, price usually opens, trades higher, then expands lower, and closes near the low. An open, high, low, close sequence. Now, guys, these are not trade models. They simply describe how price delivers throughout the day. And understanding how a daily candle forms is a starting point for understanding directional bias. Okay, so after understanding the structure of a daily candle, the next concept to be aware of is AMD, accumulation, manipulation, and distribution. Now, this framework is often called the power of three. It describes how price typically unfolds throughout the trading day. And this isn't a setup, it's simply a way to describe how price tends to behave during the trading day. Accumulation usually happens when price is balanced, often around an opening reference or an area of equilibrium. Manipulation is the phase where price moves away from that balance, usually clearing liquidity on one side of the market. And that move often creates the illusion that price intends to continue in that direction. And finally, distribution is where the real delivery takes place, as price expands away from the manipulated side and moves into the opposing objective. Now, not every day will show a clean AMD cycle, but understanding this process helps explain why price behaves the way it does as the day unfolds. Okay, so on this chart, you can see the full AMD process played out within a single trading day. Price begins trading in a relative tight range. This is the accumulation phase where the market is balanced and rotating around equilibrium. After that balance forms, price pushes higher for a short period of time. That move marks the manipulation phase, where liquidity is drawn from one side of the range, and that push higher doesn't hold. Once liquidity is taken, price reverses direction and begins expanding lower. This is the distribution phase, where the real delivery of the day occurs. Now, notice how the largest expansion happens after the manipulation and not during accumulation. And this is a sequence that helps you explain why early price action can be misleading and why waiting for clarity matters when framing bias. When I open as a daily reference. So in forex, a new trading day starts at 5 p.m. New York time. That's when the daily candle opens. For indices and commodities, the daily candle opens 1 hour later at 6 p.m. New York time. Price trades for a few hours after it opened. Then at midnight New York time, things began to change. This is what ICT calls the true start of the trading day. This is when the algorithm kicks in and starts doing its work. From here, how price behaves around midnight open becomes important. And depending on bias, when price is trading above the midnight open, it will often look to trade lower. And when price is trading below midnight open, it will often look to trade higher. and you don't need price to move immediately. You are simply observing how it reacts and where it prefers to trade. And over time, that interaction begins to give you context as the day plays out. Types of daily candles. Okay guys, if you spend enough time watching price, you start to notice something after a while. Not every trading day behaves the same way. Some days are simple, price picks a direction and just keeps going. Other days are the opposite. Price moves up and down, tests both sides, and never really sticks to a direction. And because of that, you can start grouping days by how they behave. You'll see directional days, indecisive days, and days where price is changing behavior. So on directional days, expansion is usually clean and clearly favors one side of the market. On indecisive days, price stays balanced, it trades above and below the open, but nothing really follows through. And then there are days that suggest a possible reversal. One side gets ejected and price starts moving the other way. So guys, as you go through the charts coming up, pay attention to how price behaves. This is about observing and getting a feel for the different types of days you'll see in the marketplace. Okay guys, so here's a bullish daily candle. I'm showing this on a lower time frame so you can see how price moves during the day, not just the open and the close. So when you look at it this way, it's easier to see how the day plays out. Price spends most of the day moving higher, and the close reflects that. This is what a bullish day looks like from start to finish. Okay guys, this is a bearish daily candle. Again, this is on a lower time frame, so you can see how price moves through the day. As the day goes on, price spends more time moving lower. Any moves higher don't really last. By the end of the day, the close gives you a clear picture. That's what makes it a clean bearish day. Okay, so this is a bullish reversal daily candle. So the main thing here is the change in behavior during the day, and it doesn't finish the way it starts. So early on, things look weak, but by the end of the day, price is closing stronger, and that change is what defines the reversal. And guys, how the day wraps up tells you a lot about what really mattered that day and how price chose to finish. Okay, so now we have a bearish reversal daily candle. Now, the key thing here is how the day changes as it goes on. So it starts out strong, but the strength doesn't last. As the day moves forward, price loses momentum and finishes much lower. That shift during the day is what defines the reversal. And guys, how the day wraps up tells you how price really wanted to end that day. Right guys, so now we have a bullish indecision daily candle. Now, this kind of day moves around a lot, but doesn't really commit in one direction. So you'll see price push higher, then pull back and do the same thing again. But by the end of the day, price hasn't made a clear statement. And there's some upside bias, but no real follow through. And that lack of commitment is what makes this an indecision day. Okay, so now we have a bearish indecision daily candle. Now, this kind of day doesn't really go anywhere. Price moves up, price moves down, but no side really takes control. And by the end of the day, price finishes close to where it started. There's no strong follow through, just back and forth movement. And that balance is what makes this an indecision day. Directional bias, probability framework. Now, directional bias is not certainty. It's an anticipation, not an outcome. Bias is about probability, what price is more likely to do, not what it has to do. And having a bullish or bearish bias doesn't mean price must deliver that way. It just frames your anticipation based on the information you have at the time. And sometimes, guys, you'll be wrong, and that's normal. You're not going to be right every day, and you're not supposed to be. And that's where the problem comes, when ego gets in the way, and price starts going the other way, and you refuse to accept it. And that's what ICT always says this: never ever marry your bias. And if the market isn't doing what you anticipated, that's completely fine. You just say to yourself, all right, I'm wrong about today. And you adapt to what the market is actually doing right now. And guys, I'm never right all the time, but I never let my ego take control of my decisions. And that's why bias isn't about being right. It's about staying aligned with price as information changes. Previous day high and low. Right. So one simple way to align with daily bias is by watching prior highs and prior lows. And when I say previous day high or low, I don't just mean yesterday. It can be any recent day that price is still reacting to. And when price starts moving early in one direction, it's often working into an old reference that's still in play. And those old references aren't only highs or lows. They can also be higher time frame imbalance, areas where price still has unfinished business. Now, this is where I see traders make a common mistake. As soon as an old high or low gets taken, they immediately start looking for a reversal. But there are plenty of times when price isn't finished and just keeps going the same way. And that's why it's so important to slow down and watch how price behaves after those highs or lows are swept. Because at that point, you're not guessing the next move. You're letting price show you whether it's done on that side or whether there's still more to go. And that's how your daily buy stays grounded and connected to the bigger picture. Now, let's look at this chart. Focus on what happens once the previous day low is taken. Price trades below midnight open, sweeps previous day low, and then starts delivering higher intraday. Now, what's important here is a change in behavior after that liquidity is cleared. Once that side is done, price is free to move the other way. Now, this is a good example of how a daily level can shape intraday delivery. Now, look at the same idea from the other side. Watch what happens as price moves higher and reaches the previous day high. Just like before, the focus is on how price behaves once the daily level is engaged. Now, this is simply showing how a daily reference can frame intraday delivery. So, in simple words, daily context first and everything else follows. Right guys, so this is previous day low taken, draw towards previous day high. So price moves lower, trades into previous day low, that level gets taken, but price doesn't stay below it. After that, price starts moving back up through the daily range and price continues higher, it works back into the previous day high. So one side of the day range is cleared first and price then delivers across to the other side. Right guys, in the last two charts, you saw days that ended inside the range. But here, price doesn't do that. Over here, once the low is taken and rejected, price goes on to target the previous day high. Now, this is me showing how the algorithm can deliver a trading day once liquidity is taken on one side. And that's why not every trading day is going to behave the same. And I'll show you more chart examples of how different days behave. Right, so in this example, we have previous day high taken, draw into previous day low. The price trades above the previous day high and fails to hold. From that point, price unwinds back through the range and continues lower. Here, the target was the previous day low. This is another way a trading day can deliver once one side is cleared. Okay guys, so in this example, we have previous day high taken, continuation to higher time frame high. As you can see, price moves up, takes the previous day high. After that, price doesn't change direction, it keeps going higher. And as I mentioned before guys, when we talk about previous highs and lows, it's not limited to just the prior day. Price can also be reacting to a previous week high, a previous month high or a higher time frame imbalance sitting above. And that's what's happening here. The prior day high is taken, but there's still another draw on price above it. So price continues higher. And on days like this, price doesn't always stop at the first level it reaches. Sometimes it keeps going because there's still unfinished business higher up. But for now, this is just about observation, looking at different days and noticing how price behaves when these highs are taken. Okay, so in this chart example, we have previous day low taken, continuation into higher time frame imbalance. So in the previous chart, price took the prior day high and continued higher into an old high. Now in this one, the opposite. Price moves lower and takes the prior day low. After that, price has to reverse. It keeps moving lower and continues into a high time frame imbalance below. And when you look at these examples side by side, the behavior becomes clear. Some days, price takes a level and then changes direction. Other days, price takes a level and continues into something larger. And that's why prior day highs and lows are treated as key references and not places where price has to stop. Okay, so in this example, price stays inside the prior day range. The previous day high is not taken. The previous day low is also not taken. Price trades back and forth during the day without expanding either side. Now, this is a day where price remains balanced and delivery stays contained within the range. No external liquidity is drawn. Now, you'll often see days like this with lower volatility, especially ahead of major rate follow news like NFP, CPI, or FOMC. And it's simply another way the algorithm can deliver a trading day. Right, so here we are looking at price in a weekly context. Now, notice how price trades down into the weekly low and interacts with the level. And that interaction sets the tone for how the rest of the week unfolds. Once the weekly low is swept, price shifts behavior and starts delivering higher. Now, this is a very good example of how higher time frame levels can influence price for several days. Session behavior within daily bias. Alright guys, so back in episode 3, we talked about session behavior. And this is where it really starts to come into play with daily bias. And once you have a daily bias in mind, session behavior helps you see whether price is actually willing to go that way. So some days you'll see price expand cleanly, other days stay balanced, and some days give you that slow, choppy delivery. And when session behavior lines up with your daily bias, meaning price keeps pushing and doesn't keep retracing, that's when the bias starts to feel more solid. But when price keeps stalling near the key levels, overlapping sessions, or repeatedly rotating back and forth, that actually tells you the market hasn't decided yet. So session behavior doesn't create bias, but it gives you feedback. It shows you whether the bias forming is being respected by price or whether it's being ignored. Okay guys, the chart examples we're looking at here, you've already seen before. The difference now is that the sessions are marked, so you can clearly see how the day behaved through each session. Now, we won't go into detail here since session behavior was already covered in episode 3. I'll just quickly walk you through the chart examples so you can see how it played out. Okay, so in this example, price trades higher during Asia and takes the prior day high. That sets the Asia high. When London opens, price trades just high enough to take that Asia high. After that, price starts trading lower. During New York, price trades back above midnight open, then rolls lower and moves down into the prior day low. So now you can see how each session played its part in delivering price to the draw. Alright guys, so again, we've seen this chart in the previous slide, and here the daily context is already in place. The prior day high, prior day low, and the midnight open are marked. During Asia, price is quiet and contained. As London opens, price starts delivering. Then into New York, we see a retracement into the imbalance, and price continues pushing higher. Now, the session itself isn't creating the context. It's simply showing how price delivers once that context already exists. Okay, so in this example, price consolidates during Asia. As London opens, price is trading above midnight open, then trades lower, but does not make the low of the day. When New York opens, price trades lower, takes out London low, and makes the low of the day. After that low of the day is formed, price starts to trade higher and rallies up into an older higher time frame imbalance. So across the day, Asia consolidates, London trades lower, and New York creates low of the day before price delivers higher. Now, this is a kind of daily profile or daily delivery profile you start to recognize when you stop chasing moves and let the algorithm show its hand. Alright guys, let's bring everything together from this episode. Now, directional bias is never built from a single candle, a single level, or a single moment. It forms by stacking information and observing how price delivers around it. And the daily candle shows you how the algorithm is delivering the day. And we've seen through the charts how price can rotate or continue pushing into an older high or higher time frame imbalance. The midnight open gives you an early reference for where price is finding acceptance or rejection. And prior highs and lows highlight where liquidity is resting and where price is likely to interact. And also, session behavior shows you whether price is following through or staying balanced. And higher time frame objectives give context for where price is being drawn. Now, when these elements start aligning, directional bias becomes clear. And when they don't align, that's still information. Now, guys, in our next episode, which will be episode 5, we'll focus on how the same framework can be used to anticipate these moves before they fully play out. But for now, the work is simple. Go back through past days, mark the midnight open, track how prior highs and lows are treated, observe how each session delivers price. And over time, this process trains your eye to read directional bias objectively and to know when patience is the correct decision. Okay guys, that's it for today. And if you found value in this, go ahead and like the video and subscribe to the channel. It really does help more than you think. And if you want the PDF for today's lesson, it's waiting for you in our Discord. The link is in the description below. With that said guys, have a great trading week and I'll catch you in the next episode. Take care.